I'm going to create the platform there for my smart contracts. But for me to close the loop and get my revenue, I'm going to use Bitcoin. So because I want to issue my contract and I want to get paid with Bitcoin. Can we do that right now, or is that the issue that we're having right now, in merging these two concepts of technology and cryptocurrency? That's my confusion.
So I think there are two issues here. The blockchain is basically a database of information that you can program in a certain way that you have all the contingencies there. Okay? Now the question you bring up is, when the contracts are negotiated, how do you get the monetary value there? Okay? So there are a couple of things you can do. One, I think in this crowd is probably not ideal, which is the payments is kind of on the side and you do it kind of the way we do it now. The other way is, as my colleague here suggested, if you have digital currencies that are fiat that compete with Bitcoin, you can sort of get that. But I think from an economist standpoint, there is a lot of value in having a database that is very clear on who owns what at what time. And if Bitcoin is the answer, so be it, but Bitcoin has this volatility. And I think I heard this morning, the only people using Cyber are those people that are buying Cyber with Cyber. I have some counterexamples. I advise some firms that do interesting things, but it's not at that critical mass. It hasn't reached, as Professor White calls, the network effect yet. So we have something that if we have to force the blockchain to wait for the Bitcoin or the other currency to get the critical mass, aren't we losing some efficiency we have?
Thanks. That was really interesting and insightful comments. I appreciate that. I'm Anita Vadavata. I'm based out of the Valley, Silicon Valley, and founder of Miso Labs. My question is really purely wanting to understand from a regulatory policy environment as to the understanding of knowledge as to the pace of technology versus policy making, right? Because technology grows much faster, moves much faster. Is policy able to catch up enough to understand where the technology is heading and then put controls on how to actually regulate it? So I want to understand from your standpoint, from a central bank, from a Federal Reserve Bank standpoint, how do you regulate something you don't even understand because it's a different pace, right? It's an evolving technology, is blockchain. But we're not just talking about blockchain, we're also looking at blockchain combined with other technologies like AI and others. So it's not a singular trajectory, we're looking at a convergence. So how does central banks, how does banking system in general catch up to where tech is heading? And how do you do policy making around it? But it's driven by protocol.
Let me ask you a question. We're fighting for this one here, actually. I think it's a very good question.
That's a great question, actually. I mean, I think emerging countries are going to adapt to it a lot faster than the developed countries. Reason being is, I mean, these are guys that are economists, so I mean, like, they can tell you whatever afterwards. But from a strategist side, I mean, like, we go in and I said, okay, where is this now and where is it going? And how can we control it where it doesn't really disturb the current market either? And yes, everybody's going to control it. I mean, all the central banks I talk to, they all want to control it. They want to get it. Yes, they can. Reason being is, I mean, I was talking to somebody in the U.S. Treasury. I said it takes only one signature to make this criminal act, to buy or sell currency. All it takes is, I call him Munchkin. I say all it takes is a signature from the Treasury Secretary. Say, hey, it's illegal.
That's not very nice. Come on.
I know him personally. Well, actually, I know him personally.
I'm sure you do, but it's still
so
not
that's
nice.
what I always call him that. So I said all it takes is one signature. I mean, and emerging markets, I think the reason being is they're adapting it because we are working in emerging markets. I mean, in the U.S. Federal Reserve, I mean, like in any of the developed countries, we can't even approach these kind of central banks because they're going to end up doing their own. I mean, Russia is doing their own. So in the emerging markets, they don't know any better yet. And they really don't understand the technology part of it also. And they don't know, and they want to be part of it. And I said, okay, well, you know what? We have a solution for this. And that's where I think they're going to basically going to be adapting to and developing new policy and implementing it.
If I could jump in.
I don't think so.
I don't think so. And I think, and if I could jump in there, I think when you look at, and I'm taking it from the Federal Reserve, but also the Bank of Japan, each nation's probably going to handle this differently. The UK has what they call the sandbox approach, as well as Singapore. And everyone knows what sandbox is as when you were a child, you were placed in a sandbox, you build up your own kind of product, and your parents look at you, and they decide when they want to leave. So there's a time period for that. The key is a time period for that. The reserve banks here, at least the Federal Reserve, as well as the OCC, the Security Exchange Commission, the CFTC, our regulatory bodies here have not decided on whether to either call it a sandbox or you call it a pilot. So when you look at the regulatory policies here in the US, they're evolving, but they're in the process of being evolved. So there's never going to be a point where they're going to be ahead of you. And I'll give you an example in technology. Just look at it from a technical standpoint, the Reserve, or at least the Fed or the OCC, has created what they call the supervisory regulatory letters. These SR letters are SR 11.7, SR 11.10. These letters are pretty much covering information technology. But it's been around from a linear approach. So it's not looking at a multilinear approach. But there's opportunities for it to grow gradually. So what you're going to find as technology grows, technology is always going to be ahead. The reserve banks, at least the regulatory policies here, are going to always have this line of communications with the constituency with the hope of learning about those new technologies and then eventually actually creating new policies to actually have some kind of governance and controls in place.
Well, also in the U.S., there's about 8 or 9 different agencies going to fall under. And I think they're all fighting over who's going to go first on this. And the market cap on this is about $150 billion anyway. So it's not really, it's just almost barely noticeable because there are a lot of funds out there that are $1 trillion market. So I mean, it's still kind of evolving. I mean, and the regulators are looking at it. The ones I talk to, well, it's interesting, but who's going to take the first step first? So
the Federal Reserve has actually been pretty cool about it because they see their view as regulating banks, and these are not banks. Exactly. It's the Treasury's Financial Crimes Enforcement Network that's been sort of the most dogged about imposing know your customer rules, anti-money laundering rules, and they're the ones who pose the real threat of crushing emerging technologies.
But I think it's fair to say that regulators are struggling with the pace of innovation. There was I think this February, the IOSCO, that's the International Organization of Securities Commissions, they issued a report on fintech innovation. There was no word about ICOs in the report. Look it up. They were not aware ICOs were going on. And I think that's a reality. Now it has changed, but this February, the world for them was different.
They missed 1,000 new central banks emerged for the last 6 months in this report. Okay, just one final question. So many hands. So we will eat some time from other section. It's very interesting. I purposed it to you and then one or
Sure. Thanks guys for doing this. This question is primarily for Mr. White. So we talked a lot about economic policy, which is built on economic theory, and one of those economic theories is that deflation is bad, and that we need a little bit of inflation that's healthy. When we really live in a deflationary world, right? Technology companies like Amazon lowering the price of goods constantly, consumer prices are falling, right? So we don't really live in a deflation world, we live in a deflationary world. So a lot of the economic policies and the way that central banks think about doing business is based on economic theory that may or may not be outdated. I'm wondering, now that you guys are talking about blockchain and talking about crypto, is the real big idea not how a centralized authority can use decentralized technology, to get some skin in the game and be a part of the story? Is it really maybe more about looking at these ecosystems and observing what happens when natural law takes control and plays out in a highly rapidly evolving ecosystem rather than decades to watch economic theory play out and observe what happens? Maybe now we can learn how to be better central banks by watching this thing happen in the scope of just a few years. Hopefully that question makes some sense.
Yeah, there's a lot bundled into that question. I wouldn't say we live in a deflationary world. It depends on what country you live in, how inflationary your central bank is. If we define inflation as a rising price level. So Venezuela, it's an inflationary world. But yes, goods are getting cheaper, and there's no harm in letting prices fall if goods are becoming cheaper to produce. And that was the world of the classical gold standard. Gradually falling price level, people enjoying a higher standard of living by their incomes going farther. And there's nothing wrong with that. There's no reason to fear that. What I think is great about the competition of cryptocurrencies is that we have different models. We have, this was relevant to an earlier question, we have Tether, which is pegged to the US dollar. We have projects to peg the value to gold. And we have those that, of course, float and mostly float upward. And so if you're buying with Bitcoin, prices are falling, so that's a deflation in a sense, but you know, nobody complains about it who owns Bitcoin. So we can learn from this market what consumers really value in a medium of exchange. I don't know whether central bankers will take advantage of that, but I hope so.
Yeah, that's, by the way, this device worth of $3 million if we 30 years ago. Camera, storage, and so on. Screen, it's $3 million device 30 years ago. It's a big deflation. Now it's 300. Very big deflation. Maybe GDP is not calculated in the right way. So the last question. Okay, to the last question.
Hi, I wanted to ask, what size does the crypto market have to be too big to fail so that monetary policy has to come in to respond to it? And what size do you think it would have to be?
That's a difficult question to answer, but let me give you some analogies. So in May of 2007, Ben Bernanke gave a speech that the subprime market is too small to cause any systemic disturbance. At that time, it was a $150 billion market. So it really depends on the knock-on effects and other systemic properties, not just the value of the currency outstanding out there. And currencies being too big to fail, I don't know exactly what that means. Because fiat currencies can get bailed out by just taking them off and stuff. But the other way, I don't know what that means. I think what you're asking is, if it gets too big, when does the shadow fiat come in and take it over? I think that's what you're asking.
When the regulators come in.
Yeah, so if that's what you're asking, it's going to be dependent on what type of disturbance that occurs.
Well, I think any institutional, if there's an institution capital loss in this space, I think it'd be too big. I mean, everybody will step in very quick at that time.
Okay.
I think that's what you meant.
Yeah. Thanks a lot. I think that it's a very good beginning for such academic discussion for blockchain. It's very important to make it robust, and it's also helpful for self-regulation, regulation. Let's make a photo.
Okay, also one more thing. If somebody's doing an ICO, a friend of mine, she's doing a TV show with CNBC, and following companies before ICOs and after ICOs. Her name is Victoria Saucier. I think she just left. She just went outside. See her if you guys have an ICO program. So they can put you guys on TV.
Yeah. While they're making photos, I'm invited for the next panel, Capital Markets Without Middlemen. Alex Felix, Gil Pencino, Bradley Ruto, Michael Mona. Let's make a photo.
Oh, we should talk.
We should definitely talk.
It's fun stuff.
It's great that you.
Hey, how you doing? Yeah, Ken, pleasure.
Okay. Michael, please. Mitchell. Alex Felix. Mitchell Manoff. Bradley Reuter, please come in. Yeah, please come in. Okay, please take your seat. Yeah. Here, let's take mic. Please help with mics. Please, everybody leave mics. Okay. Okay. So we are running out of time a bit, so we will shorten this section for 30 minutes, and we will be in our agenda. So while we are taking microphones, I can give somebody to pitch yourself, pitch your product. Who wants to pitch himself, to vitalize others with his ideas? Okay, come on.
All right, cool. 1 minute, all right. This is not an ICO, this is not a blockchain technology. What? It is related to cryptocurrencies though. So your grandma, does she know about Bitcoin? She's probably heard of it. What about your mother? Your friends, they've heard about Bitcoin, right? And they hear millions of people making millions of dollars. It's this really hazy, weird space, but it's kind of scammy, it's grimy, it's mucky. We want to bring in the general public to Bitcoin and into investing, right? So we all believe in what cryptocurrencies stand for, but there's this huge barrier to entry, right? There's this huge learning curve. We want to bring it all together in one space, bit-buddy.com, making so it's possible for your grandma to understand and invest in Bitcoin herself. bit-buddy.com. My name is Maverick Kuhn. If she loses all of her stuff, we are not financially advisable. No, we bring all of the stuff. We provide a conservative portfolio. We go over the whole thing, free crash course, trying to build a community of trustworthy individuals, not people trying to grab into your pockets. bit-buddy.com.
Thank you, very energetic. So let's turn to the capital markets without middlemen. We just had an interesting point in our discussion when we discussed how central banks should react in a new complex situation when capital markets are frozen, when too big to fail institutions have a lack of capital and they are afraid of each other and stop giving loans, liquidity shrinking, and this becomes a vicious circle. So what about if there is no middleman and no too big institution? This is the topic of this discussion. And also, can capital markets be more efficient, more smarter, and deliver more precise pricing signals and also have lower transaction costs? So who would you like to start first? By the way, Bradley made the first electronic transaction in history. It was a futures or stock?
Futures.
Futures. Great.
So thank you, everyone. Before I start, I'd like to do something I've done in all the talks I've given on Bitcoin, and that is a show of hands. How many in the audience own Bitcoin? And thank you. And, wow, that's the biggest number yet. How many own alternative currencies? just as many. I was speaking at the Silicon Valley on Friday at the Global Technology Forum. It was on Sand Hill Road. About the same number of people. Some in the audience were venture capitalists like Pitts Johnson of Asset Management, a very famous VC. And I did the same poll, and 3 hands went up in the Silicon Valley. That's what's interesting about this Bitcoin play. It's not at all, not nearly focused in the Silicon Valley. It's global and all over the world. So that's a big distinction. I've been involved in the capital markets since a very young age. I grew up on a small farm in Iowa, which is a small state in the Midwest, and I was in charge of hedging our one corn contract, and I've basically traded commodities all my life. When I came to Wall Street to trade government bonds for E.F. Hutton, the bid-ask spread on the long-term 30-year bond was 0.5 point. To put that into perspective, that would be in Bitcoin, that would be a bid-ask spread of $320. So it was very early on. It was all voice trading. It was an over-the-counter market where you pick up the telephone and call another dealer. I was with E.F. Hutton, or there were several brokers at the time. And one night on Wall Street, I happened to become friends with a guy named Bernie Cantor. And Bernie Cantor had this idea that he was going to put bond prices on a screen and be able to trade them electronically. I said, that's a good idea, I'll take one of those screens. So Monday morning, a technician came in and brought a television screen that's about as big as that thing, whatever that stair step is. So it was a gigantic screen. If there had been an earthquake, I would have died. And at the end of the day, I turned in my blotters to my boss, and he's looking at my trades, and he goes, "What's this?" I go, "Well, there's a new broker that's trading electronically. That's this big screen here, and I saved $85,000 by using this screen." And he goes, "We at E.F. Hutton do not put our prices out of the screen. Come with me." So I go back to his office, and he's blasting me for trading on this new system. And then he said, "How much did you save?" I go, $85,000. The next week, he had a screen on his desk. So that was very early on. As I mentioned this morning, I saw financial futures very early in the marketplace. That was a crazy idea, like Bitcoin. The fact that we needed futures contracts and derivatives on the largest commodity of all, money, seemed like a crazy idea. I got thrown out of some of the finest banks in New York and Chicago trying to explain to them how they could use financial futures to hedge their interest rate risk. So this is very early times. I believe that the march to efficient markets will continue. I was schooled at the University of Chicago. I was going to night school at the University of Chicago and trading on the floor of the Chicago Board of Trade. But at night I'd be listening to these Nobel laureates talk about the efficient market theory. And I used to sit in the back of the class and snicker because the markets weren't even close to being efficient. I had found a place to stand in the bond pit where I could see a Dow Jones screen in the other room. And so back at those times, PPI and CPI, surprises would come out during the market, and I'd have an edge. I'd be able to trade 5 or 10 seconds before my competitors. My competitors in the pit basically thought the Federal Reserve was an Indian reservation in Wyoming. It was not a sophisticated bunch, but it was being in the pits was quite fun. Grown men yelling, kicking, screaming, and shoving and spitting. It was fabulous, and there were indeed edges and volatility like we're experiencing now. But I was strongly convinced that would go away. I was having dinner with Leo Melamed, who is a very famous guy in Chicago. He's the chairman of the Chicago Mercantile Exchange. We were having dinner at Gene and Giorgetti's in Chicago, and I said, "Leo, Your Chicago Mercantile Exchange is going to be a large, rather irregularly shaped museum. And he looked at me and said, not in my lifetime, Sonny. It's now, the Chicago Board of Trade, where I used to trade, is now a golf pitching range. So the reason that you see guys like Jamie Dimon talking about Bitcoin is that he's talking his book. I think Jamie Dimon realizes deep down what I've been predicting for a long time, and that is banks will become as plentiful and as useful as Blockbuster video stores. They're going away. They're middlemen. This is not a good time to be a middleman. What's the difference between a venture capitalist and a travel agent? Anybody? Nothing. Nothing. They're both middlemen. I said this at Sand Hill on Friday. It did not go over well. One arranges a trip, one arranges a trade. They're both middlemen, and they're quickly going away, with or without digital currency. But digital currency is hastening that path. That's why this is such an interesting phenomenon. The first phenomenon that I know of, that this phenomenon is being led from the bottom up by all of us. Wall Street hasn't gotten it yet. There's a couple of firms like Fortress and a few banks that have saw it pretty early on, but Wall Street is not involved. That's why Bitcoin's going up, because they're just now starting to take their positions. There's one attorney told me last week there's 94 hedge funds in formation to buy digital currency. What are they going to buy? They're going to buy Bitcoin until they figure out the space, and that's why Bitcoin has a bid. Why is Ethereum soft? Ethereum is trading weak because all of these ICOs have Ethereum that they need to sell for payroll and expenses and to pay the bounties, which is another story. So the Bitcoin is a real macro scale. It's fun as a speculator to think about what could happen with Bitcoin, because it could literally go, Bitcoin could literally go to unimaginable levels, and the cool thing is you could still use it to buy a double decaf non-fat latte, because it's infinitely divisible. And it's really a spectacular currency in that regard. But I'll let the smart guys chime in.
Well, thank you. That was a great introduction. First off, I want to wish Bitcoin a happy birthday today. It's exactly 9 years since the white paper was released.
Wow. Are you Satoshi?
I'm not. I wish. He actually has a problem right now, though, because if he touches one of his coins, the whole thing could come tumbling down, temporarily at least. His reserves are so big that people sort of believe at this point that they'll never be touched, but they're worth tens of billions of dollars. So the white paper is released in the depths of the financial crisis. I spent a decade on Wall Street pricing both the lowest coupon high yield bond for a company that is now defunct called Forest Oil back in 2008 or end of 2007, 8, and then also the highest priced high yield bond in the beginning of 2009 for one of the gaming companies that shall go unnamed. So sort of that period of time in which Bitcoin was proposed was a tumultuous one within the capital markets. And later in my career, I sort of cleaned up the mess working for the Royal Bank of Scotland and a bad bank, which was tasked with post-bailout. The Queen of England gave a bad bank to a group of people and said, please help me sort out this mess. I don't know what we hold, I don't know what's here, and I'd like to understand. So what you kind of have in the banking system is a tree of money from retail people that flows up to the top and then gets invested and leveraged by very few smart people, and those people are purported to be the masters of the universe. So, Bitcoin kind of came along and was a very different instrument. It was a democratizing way that you could buy into an alternative system or store of value or currency. And I think the main takeaway of everyone having tried to create an analogy for Bitcoin is that it's really anything to anybody. So in different countries, it means something different to those people. Here in the US, there are now sort of traditional markets. The CME announced this morning that they're going to launch futures on Bitcoin. So it's becoming accepted in more mainstream ways, but I still argue that if we slow that acceptance down, it'll actually have a better long-term future. There's still a lot of issues with the technology, with the teams behind the technology. They announced that there's going to be futures today, but I don't know which fork they're going to hold or which one that future would point to. And so there are tremendous amount of issues. With too much money flooding into the space too early. Now with things like Bitcoin, it's certainly, this is a simple asset with a simple use case. And then we also discussed things like Ethereum, which I'll talk about after I let everyone give introductions. But to sort of summarize, I made the transition into the space because I saw a lot of these challenges at the firms I worked at, where there were too few people making decisions that were too big, and they didn't necessarily understand the details of what they were doing. And I sort of saw a world where kind of democratizing finance, things like AngelList, getting people involved in projects and helping to sort of bootstrap those projects by turning your customers into owners as well, was a very powerful concept. And I sort of initiated this concept around what happens if you owned an airline that was owned by the community and not by a for-profit company. So when you strip out investors and you strip out profit being pulled from a network, you can actually deliver either a better service, meaning for the same price of flying JetBlue, you could get twice as much legroom, or you could deliver a lower cost. So, I think the role of middlemen is changing more than it is going away. There's still going to be businesses that are going to be run for, run at sort of minimal margin. And when you think of Amazon, what you see with Amazon is a business and a service that no one can get away from because it's built this huge network effect. It's delivering the lowest cost. There's still a middleman, but the role of how they operate is becoming more programmatic. And that's what I think is interesting. Is not middlemen will not go away. When we think about the evolution of the crypto space and what ICOs have become, we've actually gone 2 steps forward and 1 step backward. Meaning, at first, people were actually funding decentralized smart contracts. They were doing so anonymously. The funds were being pooled and used, and those tokens they would buy would represent an interest in that network. Now we're seeing, to fit back into the regulatory framework, and I'm not saying that this is for better or worse, you're seeing middlemen reintroduced into the system. In regions like China, they actually prefer to have someone who manages the syndication of their investment. In the US here now, we have platforms that are going to be built off AngelList, platforms that are going to be built around helping execute fundraising in this space. So we're almost reintroducing the middleman. And it's going to be important going forward to understand, especially for tokens that are going to power networks, sort of how those, who's earning what from these, from the launch of these new networks. So I'll probably discuss a lot more, but I don't want to take too long for Mitchell.
Take as much time as you want.
Let's see. Is it on? Yeah. Okay. Mitch Manoff. My company is Corinthian Partners. We're an investment banking asset management firm. We made payroll for 21 years, so that's a heck of a lot better than the 14 years I spent at Lehman Brothers, who are no longer making payroll. Or for that matter, the firm I was with before, Drexel, which is no longer making payroll. Or the company that I was with before that, which was Merrill Lynch, who are making payroll, but they're referred to as Bank America. So either I am the most unluckiest person in the world, or there is something going on. And what I do see here is the whole concept of this time it's different. No, it's not different. This is very, very similar to what happened 20 years ago, 18 years ago, 19 years ago with the internet. Was it a bubble? Well, obviously it did have its ups and downs, but there certainly were huge values that are created. Everyone who owns a single company that uses an internet protocol certainly realizes that there was a lot of value. Yet there is a lot of companies who did not have a real business plan. Their business was not solving a solution. Their business was just starting something to make a dollar, and we hope we get a business plan later on. And those are things that I must say I have as wallpaper with some of the companies that didn't work out. But at the end of the day, one of the great things in life is you get a second chance. And you truly get a second chance to try to figure out how you could solve a problem with these types of companies. Now, my friend Brad asked how many people bought various coins and things like that. I'm going to ask an easier question. How many people saw The Godfather 1? Virtually everyone. How many people saw The Godfather 2? Just about everyone. Well, the whole concept here about capital markets without middlemen. If you remember Godfather 2, a young Vito Corleone was in a position where he was being shaken down by a local don called Finucci, okay? He was being shaken down, and Finucci said, "I just want to wet my beak." Now, his definition of wetting the beak was taking a significant cut of young Vito Corleone's profits on his legal or illegal operations. So, and I won't give you a spoiler alert to the 3 people who didn't see Godfather 2, but he took care of his middlemen. Now, by no means am I suggesting that we go out and we do what Vito Corleone did. But what we need to do is figure out, and in large measure, that's what blockchain does. How we can be cutting down the middleman to an acceptable level, to the extent that they are providing value. I teach venture finance, and I have been for the last 10 years over at Baruch, and I love every minute of it. And one of the biggest things that I say is, what value are you providing? If you're providing a value, you have the potential of having a business. If you're not providing value, then you don't have a business. Or, as Peter Drucker said, probably the greatest business writer on the planet, he said, he would ask, what is the definition of business? What is the goal of business, rather? Well, the goal of business is not to make a profit, but the goal of business is to create a customer. And one of the great things about an ICO that is properly done is that it's going out to be able to create a customer. That's one of the things that we're trying to do here. One of the things we try to do at Corinthian Partners, we have a mission statement, and sometimes we keep to it, sometimes we don't. But it basically says, we solve problems using securities, insurance, and providing advice. 9 words, mission statements typically 10. We under-promise, over-deliver, sometimes the other way around. But the fact of the matter is, that's what I'm seeing here. There's an entire ecosystem that is building up. And the exciting thing about being involved in some of these companies, I am on the board of advisors of 2 companies, Latoken, which I'm very proud, fabulous management, fabulous solving problems, and SportsCoin, which I just joined recently, which is a really cool company. What I am looking at here is an entire situation where you could be solving problems, providing, in my particular case, liquidity for illiquid assets. Now, one of the things that Brad said, he spoke about some of the larger companies, larger banks not getting it. And at the top level, at the C level, I happen to agree with that. But if you looked at the Fortune magazine article, the September 1st issue, it was titled Blockchain. And it gave a pretty balanced story. It talked about some of the issues that you have with bad guys coming in there, and it talked about some of the great things that are being done. But they ended up focusing on a young lady in her department and what that company was doing in the blockchain area. Now, what company was she working for? JP Morgan. So you have someone at the top saying certain things are frauds. You have someone who is being focused. Their entire division is being focused, and they're being compensated a lot of money because JP Morgan does pay their people very well. And the top doesn't know what the bottom is looking for. One of the great things about being in front of a group like this is that everyone here in this room gets it. Everyone here wants to be involved with something that is going out, that's going to be, as we're supposed to be saying here, capital markets without middlemen. They're trying to do this better. Now, what inning are we in here? I think we're in the second inning of the game. However, the innings are going very quickly. It's a game that has 2 outs aside and 2 strikes and you're out. Foul balls are considered strikes on that. No unlimited number of foul balls here. So you're in a situation here where everyone here has an advantage. Some of you know a heck of a lot more of tech than others, but some of those other people know about marketing. Other people have other skill sets. The bottom line is, for us to be talking about how it's going to be working out in the regulatory standard is very important. But that's something I think we need to coordinate with the lawyers. The thing that we should be doing is figuring out how we could put together terrific companies, make terrific products, and be able to solve a lot of problems. And if we do that, we get that right, we're all going to be very successful. Thank you very much.
So I'm Debbie Hoffman, and I'm going to take right off there. There was a piece that you just mentioned at the end and what's missing. So let me just tell you indulge me for a quick story before I tell you where I fit into this piece. So this summer I was in Hawaii and I took a trip. It was a long tour around the island. And in his Hawaiian accent, the tour guide kept saying, and the lawyers, and the lawyers, and the lawyers. And I was so impressed because what do you think I am? So I'm a lawyer. But then at the end of the tour, I realized that he was talking about the warriors. So I heard lawyer, but he was talking about the warriors the whole time and how they battled on the island and they won. So the role of the lawyer here is what's interesting. We're talking about middlemen. And a lot of times when you think of a lawyer, you might even think of a lawyer or a banker or something like that as a middleman. But in this particular case, the lawyer is actually not the middleman. If we structure these deals properly, the lawyer will help you, will be your ally at the beginning of the transaction. You'll start looking at all of your issues up front. You'll look at the SEC, you'll look at broker-dealer issues, you'll vet through all of these things and you'll determine what do I need to look at and what do I not need to look at to determine my success in my launch? And how do I want to structure this? Do I want to do SAFT? How else do I want to, are there other ways to do it? So you want to properly evaluate all these things so that when you go out, when you launch, that middleman, there isn't going to be a need. There isn't going to be a need for a regulator, or if you do have a regulator, they're looking at it right, transparency through the chain. But you're not interrupting your deal flow because you've set this up properly. So that's really all. I'll give you a little background about who I am in terms of, so I practiced here on a Wall Street law firm in the capital markets in lending for quite a bit, and then I got in-house doing digital lending. And I've been working in digital lending and lending in the last, basically my whole career as a lawyer. And so in digital lending, you do see, we saw the transformation of companies that kind of fought it at the beginning and then eventually realize that, hey, there's a way to do this, to work up front to, because in digital lending there's a lot of regulatory obstacles, unlike what we have here yet. But the companies that have been and are succeeding digital lenders in lending are those that are either partnering with companies that have had a long existence in understanding regulations, or those that are innovative and structure their deals up front to be ahead of the curve of what might come down the pipe later on from regulators.
Thanks a lot. Because I'm actually doing the platform which is decentralizing capital markets, I would summarize what I see could be where middlemen could be removed. There are three big things which involve a lot of middlemen. First is infrastructure things. It's like custody, it's about clearing, it's about banking transactional system. It is all in one blockchain, Ethereum. They have all of it inside one blockchain. Second big part is about investment decisions, and third part is about lending decisions. So how we can decentralize investment decisions? So that's not only big firms dominate this investment space, but perhaps millions of people making smart investment decisions. There is a social following, for example, the new era of social investment, when there is a trader who is making good return, and then other people analyze this trader, analyze why he's doing good return, and follow him. So I think that sometime in the future you will see who of your friends in Facebook are doing good returns, and you also know this person and understand how he thinks. You trust him, and so you can follow his portfolio. Also because you do not need a lot of infrastructure, you do not need to set up a hedge fund by investing several thousand dollars into infrastructure. You don't need to spend a year with your road trip to fundraise for your fund. You just start your account, you do good return, you get followers, and actually it's like your fund manager. So any person who will have an idea how the world works, which regions, which technologies, which companies will perform better, he can go and trade and get followers and get influence. He will move money across the globe without huge cost of creating hedge fund infrastructure, proving that he has the right pedigree, and so on. So I think that this will involve far many people into investment, into making smart decisions, into analysis of the future of the global economy. And this will make money flow smarter.
Well, I hate to break it to you, but lawyers are next. As soon as we're finished disintermediating the banks, the investment banks, the venture capitalists, we're coming after lawyers. Take a look at a project that's coming out of consensus called One Law. Has anybody heard of that? What's that? This is a fascinating prospect. They're basically digitizing and containerizing in smart contracts, who would have thought, and replacing the cost, increasing the speed of a contractual commitment, and it's going to be absolutely fabulous. It's early stage, it's just beginning, but I like to say lawyers are like beavers. They swim into the mainstream and dam it up.
Okay, let's go for questions. You guys.
So in the interest of being a bit provocative, Debbie, you shook your head pretty quickly when Bradley was saying that that's not going to happen to lawyers. I'd be curious to hear your counter argument.
yeah, there's certain simple tasks that absolutely can be, can go into the blockchain. No question, there's some certain contracts and maybe your commitment up front. But if you really want to structure a deal, we're not just talking about like lawyers that can write a contract. We're talking about properly being able to analyze and structure a deal. So if you think you can do that yourself, go ahead, but you will see that you will not last those many other hundreds of ICOs that are happening at the same time. You will be failing, and the ones that are structured properly will be the ones that are succeeding.
My favorite Wall Street attorney story, I just got to share this with you. I'm still laughing at this 20 years later. I was having cocktails with a Wall Street attorney, and he was talking about a deal that he was working on. And I said, wait a minute, isn't that a conflict of interest? He looked at me and winked and said, no conflict, no interest.
I do want to highlight one thing though, as we think about blockchain as kind of this efficiency technology and structuring things correctly, and what are we investing in here? And there's sort of a big distinction between something where you actually have ownership underlying it, that you're layering in a token to sort of securitize it. There's actually many reasons why, I don't want to scare you, but why that whole market actually may not want blockchain. And the reason for that is transaction finality. So if my name can be on a cap table, I don't know that I would want to hold a token that can be stolen from me. I would just want my name on that cap table. Yes, I would want it to be transferable, and I would want the properties of liquidity, but that can be handled in a centralized setting. So the things where blockchain gets interesting are, like, how many people here know Ripple and Bitcoin? Or sorry, Ripple and Ether? How many people are interested in Ether? And is the same number interested in Ripple? By and large, okay. So these are like two very distinct markets, though, that I just wanted to make sure we think about when we think about things like Bitcoin and Ethereum and sort of what that technology and those networks purport to do, is to actually pre-program all the incentives and all the settlement versus, and maybe have a lawyer help get them off the ground. But the long-term vision is for a decentralized network that actually benefits from being decentralized versus adding liquidity, which is another part of the market.
You guys are capital markets guys, so you probably think in probabilities a little bit. So if I could ask you, over the next 10 years, what probability do you think the U.S. central bank will adopt a cryptocurrency that they prefer? And what percent chance do you think that that's going to be Bitcoin, given the technical limitations of the technology? And what does that mean for the long-term prospects of the Bitcoin-USD exchange rate?
Let me try that. I don't think anyone knows the answer, but I will bet anyone any amount of money that there will be, out of the 198 countries that are part of the UN, there will be a fair amount of countries that would be adopting that in the next 2 years, okay? Should Zimbabwe, with a $1 trillion bill, have a currency? Well, I don't think so. Would the volatility on Bitcoins be any worse? Now, it's obviously been net up, so it's not bad at all. How would that relate to the Venezuelan debacle there, where you have basically no currency there that's of any value from day to day? I would be venturing to say that if Venezuela moved to the Bitcoin protocol, you would be in a situation where it would be a heck of a lot better. And then you start going up the scale. Would it be the United States, perhaps in certain, areas in certain parts of business, perhaps in trade with Zimbabwe or someone else? But I will be assuring you it would be in some of those places, and it would work itself up with that. There's no question about it. I mean, the subject matter here is capital markets without middlemen. The possibility of saving 1 bit, or even less than a bit, is one of those things that help Vanguard, among other things, become such an incredible place to be capturing money. because they were the cheapest cost place around. And they provided something. They said, we're going to do as well or as poorly as the index, but we're not going to do actively managed accounts. So I'd like to be able to say that there would be something within 10 years, but I know there would be something within 2 years, perhaps not in the US.
So let me hit on that as well. Obviously, there's never been a currency that worked. There's been 600 currencies come and go. Probably the number's probably a lot larger than that. If there isn't going to be a currency that works, it ain't going to be the US dollar. There was an old adage on Wall Street when I learned to trade that markets have a perverse tendency to move quickly in a direction that hurts the most people. You ever heard that? I figured out what that trade is. There is one trade, should it occur, has such frightening consequences. The only thing that I can think of that's worse would be a meteor strike on the planet. What's that? That would be a near instantaneous loss of reserve currency status of the US dollar. I know it sounds crazy, and by instantaneous I mean I believe that this is something that could happen in a matter of quarters rather than decades. Something has changed in our lifetime that never changed before. The unit of time in our lifetime has gone. So would a government issued digital currency work? Nope, not unless there's limited supply. The reason Bitcoin is flying is because there is limited supply. It's not 16 million, it's actually less than that, because a lot of Bitcoin has been lost. Anybody in the audience lost a Bitcoin? The reason Bitcoin is relatively easy to trade is that you don't have to measure supply and demand. You have to measure demand, because you know what the supply is, except for those coins that are being lost. Governments will never, will never be able to restrain themselves from printing. Once they have the ability to print the currency, they can't resist. Can't resist. The dollar has gone down 96% of its value in my lifetime, and I'm still young.
I sort of wholeheartedly agree that these governments will never adopt Bitcoin, and really Bitcoin should never be adopted by a government. The whole point is that it stays outside of the clutches of these types of institutions that I don't know yet if Bitcoin can actually withstand something like the dollar can and use monetary policy to adjust. But in the long run, I do agree, those are for short-term shocks, right, and crises. And in the long term, I actually think that Bitcoin is better off as a pre-programmed sort of inflation rate, but also as an alternative to our traditional financial system. So we see things like the IMF, considering Bitcoin or virtual currency as part of I think it's the ADR basket, which is, sort of helps to stabilize, underlying financial instruments. Those things could be interesting. The governments, if they were really smart, would probably buy virtual currencies and stick them down in Fort Knox, because what's really going to happen is when there's more adoption of these things, it's actually going to continue to debase traditional currency in meaningful ways. So countries will actually go down if they can't regain control of their own currency and use it to pay their governments, and they don't have access to print it. So that will be the catastrophic effect of this being adopted by too many things, and the best way to hedge against that for governments would just be to buy some.
Back to Wall Street for a second, I just want to point out firms like La Token have a big impact on Wall Street as any other ICO that I can think of. As you all know now, when you trade a stock, there's something called T+3. That means trade plus 3 days before you're able to get your money. With digital currencies, it's going to be T+3 milliseconds. Because in digital currency, the trade and the clear are the same transaction, which is problematic if you're a clearing corporation, a transfer agent. All those people are middlemen and unnecessary and going away. The exciting thing about La Token is that the Empire State Building is going to be tokenized. Not that they're working on it now, but it will be tokenized. You'll buy 1% of the Empire State Building, You'll see it in a wallet along with your other real estate holdings. If you want to hypothecate that, you hit a button and you can instantly take a loan on that property. You'll be credited daily with 1% of the rent rolls minus expenses as it comes in. And if you want to sell that property, it's T plus 3 milliseconds. So it changes the way, it changes everything. And what will promptly cause Wall Street to figure this out is when they do the math and figure out they could save between $200 and $400 billion a year in just wasted transaction clearing fails and so forth. One interesting project also that you should keep in mind is a project called T0. It's a subsidiary of Overstock. Patrick Byrne was the first to accept Bitcoin in his online retailer. He has constantly been at war with Wall Street because of naked shorting, and it is filled with fraud. People will short stocks. They say they have them. They say they're going to borrow them, but they never deliver them. He is now putting this all on the blockchain, and Wall Street ain't going to like that very much. If I was Patrick Byrne, I'd have a food taster.
I would say one other thing that goes on is that Wall Street's pretty smart. They do try to figure out ways of taking advantage of all the things that we've been talking about. I happen to believe that you will be seeing a number of companies that are doing ICOs who will be, for lack of a better word, merging, partnering, licensing agreements with public companies so they could be able to get the money they need to be doing the ICO and then being part of a publicly traded company. So if you want to talk about something that's a public-private type of relationship, I think that's one of the things you're going to be seeing. And people could talk to me later on because it is a much more complex story, but it is something you will be reading a lot about in the very near future. I think you have to go.
Yeah, I want to take a step back from it because from what I see, I speak to a lot of corporate counsel in all kinds of companies, Wall Street, banks. And so one of the things that we're sort of missing in this room is that in this room we all understand ICO, blockchain, we get where it's going, we understand it, we know that Wall Street is going to be there. I think what we don't understand is the whole concept of blockchain and what ICOs are built on are foreign to a lot of people. So in order for us to be propelled forward, first you have to make sure that the banks and their infrastructure are understanding what blockchain is. And believe it or not, there are a lot of people that are, you sit on boards, you know there's a lot of people that still scratch their heads and don't even understand that. And then you have to take the leap to get to what electronic currency is for. So I'm not trying to say that we don't have sophisticated business people, but there are a lot of people that still don't get this. So you have to account for that in time. And to answer your question, I think it had to go about government and whether, so when you think about what governments are going to be able to use electronic currency, just also think about, take a step back to blockchain. And the only government that, well, not the only, there's a few that are embracing it right now, but Dubai, way ahead of the currency, they're in no fun, but by 2021, they want to have their entire government on blockchain. So that's just blockchain. Let's talk about currency and then making the jump to that in government after that.
Thanks a lot. That was very great. Thanks a lot. So let's make a photo. This is now our tradition. Then we will have a short break and we'll have technology and limits. And then company presentations. We will look for killer apps soon. Thank you. Okay, there are some guys who collected 2 million, right, during our decentralized capital markets panel. Okay, I think you will present and say about this during your presentation.
Yeah, my name is Sandeep Goel, and I represent Cryptor. And the basic theme of our ICO, our pre-ICO, which is now on, is how to pick out the middleman. So it is very interesting to see that in the last 1 hour or so, when we were discussing how to pick out the middleman, the pre-ICO, which we have collected over $1 million. So we have done about nearly $22 million in the 1 month or so. So that is how we think the middleman would be kicked out. Thank you.